Welcome back, learners. So, we were talking about cost of capital. In the previous session, we discussed about what is cost of capital, what are the significance of cost of capital, and we have also seen with the help of example that how we can calculate cost of debt. Let us proceed further with cost of preference shares. Just like debt, preference shares can also be irredeemable or redeemable. So, for irredeemable preference shares, we can calculate cost of preference shares using this formula, where cost of preference share is equal to preference debt divided by value of preference share. But for redeemable preference shares, just like we have used the formula for calculating cost of debt for redeemable debt, we can use the same formula for this as well. And you can see the formula is also given for shortcut method. We can calculate the cost of preference share using shortcut method, but the only catch in this case is tax rate is not applicable in this case. Okay. So, like we were deducting tax from the interest, here we cannot apply it. Here the shortcut method will be used using this formula, where preference dividend plus redeemable value of preference share minus value of preference share now. P0 means at time 0, the value of whatever your source of capital at time 0. This has to be divided by n, and then the whole numerator will be divided by Pn plus P0 divided by 2, right. So, let us quickly understand this with the help of example. Now, the company issues 13% irredeemable preference shares of face value of rupees 100 each. The flotation cost is estimated at 5%. Now, what is the cost of preference shares if the shares are issued at par, at 10% premium, or at 5% discount? Again, the three cases are given and we will see that how we can solve it. Okay. So, in case 1, when the shares are issued at par, the value will be 100 minus 5, okay. 5 is your flotation cost. Okay. So, the value will be P0 is rupees 95, and cost of preference share here will be equal to 13 is rate at which you are giving preference dividend divided by 95, that will be equal to 13.68%. Now, case 2, when you are issuing these preference share at 10% premium. So, the value of preference share here will be 110 minus 5.5, because 110 into 5%, we will get the flotation cost which is 5.5. So, the P0 will be 104.5, and the cost of preference share will be 13, which is the rate of preference share, divided by 104.5, which is equal to 12.44%. And the case 3, when the shares are issued at discount, so the value will be 95 minus 4.75, which is 90.25. Now, the cost of preference share will be 13 divided by 90.25, that is 14.40. Okay. So, this is how we can calculate cost of preference shares. Okay. Now, let us also discuss one example of redeemable preference shares. Okay. Now, if these preference shares are redeemable, that was the case of irredeemable preference shares. Now, when the preference shares are redeemable. Now, this company issues 10% preference shares of face value of rupees 100, okay, and the flotation cost is 5%. We need to find out the cost of preference capital if it is redeemable after 7 years at the premium of 10%. Okay. We will put the values in our shortcut formula. 10, which is the rate of preference dividend, 10% of rupees 100, plus we will start the bracket 110, because the shares are issued at 10% premium. This is the value of preference shares redeemable value, minus 95, that is 100 minus 5% is flotation cost, 95, and this the bracket will close and the amount will be divided by 7, because the time period for which these preference shares are issued is 7, and the whole numerator will be divided by 110 plus 95 divided by 2. And after solving this equation, the value that we will get is 11.85%. So, cost of preference shares in this case is 11.85%. Okay. Now, with this we will move ahead with cost of equity. Now, in while calculating cost of equity, there are different scenarios that we go through. Okay, like there is a case where we have zero growth. We also call it dividend yield method, with which we calculate the cost of equity capital. In this case, cost of equity is equal to dividend at the end of first year, that is D1 divided by P0, the price of share now at time 0. Okay. Why it is D1? Because since there is no growth, this dividend at the end of first year, which is whatever the dividend is declared at the end of first year, will remain same forever. Okay, because there is no growth, the growth rate is 0 in this case. Okay, so this is how we calculate cost of equity in case of zero growth. Then there is another case when the growth rate is constant. We call it dividend growth method. Okay, in this case, how we can calculate the value of share first? Our value of share, that is P0, is equal to D1 divided by KE minus G. Okay, KE is our cost of equity. What we are interested in here is KE. So, by just shuffling this equation, we can calculate this same equation can also be represented as the equation which is mentioned on the lower side of the screen, where KE is equal to dividend at the end of first year D1 divided by P0, price of share today at time 0, plus G, which is growth rate, because the dividend is growing or at the rate of at the fixed rate, which is our growth rate. Now, there is another case when the growth rate is also varying with time, it is also changing. In this case, our cost of equity is equal to dividend at the rate of, at the end of first year multiplied by 1 plus T divided by P0 plus G. G means growth rate. And then there is a case when there is no dividend at all, zero dividend method. Okay. In this case, again we will start with this equation where we are calculating the value of P0, which is equal to Pn divided by 1 plus Ke raised to the power n. Now, again by shuffling the equation, we can get the value of Ke as Pn divided by Po under root of this minus 1. Okay, this is how we can calculate the value of Ke in case where dividend is 0. Now, there is another case, we call it capital asset pricing method. Okay. And we can use this method also for calculating the cost of equity, but this method is slightly different from all the previous methods that we have discussed. In this case, cost of equity is dependent upon the risk level. Okay. So, how we can calculate KE using capital asset pricing method? In this case, what we will do, we will have the basic risk free rate of return. Okay, this is the minimum rate of return that we are getting, plus beta. Beta is beta of investment here. That means it is a measure of systematic risk basically. Okay, and the beta value has to be multiplied by RM. RM means risk which is there in the market minus risk free rate. Okay, and this RM minus RF can also be represented as risk premium. Okay. So, in some books you will see this equation, but in some books you will see where KE is equal to RF plus beta multiplied by RP. RP is risk premium, and risk premium can be calculated by subtracting risk free rate from market rate. Now, let us try and understand these with the help of examples. We have the case of zero growth here in our first example. Now, a company pays a dividend of rupees 20 per share. The dividend is expected to remain same, that means there is no growth. The current market price of the share is rupees 125. We need to calculate cost of equity in this case. Simply placing the values in the very first equation that was shown in case of zero growth, where P0 is equal to D upon KE. By shuffling this equation, I can calculate KE as D divided by P0 or D1 divided by P0. So, D1 here is 20 divided by P0, P0 is 125. We have seen the current market price of the share which was mentioned in the question, and KE in this case, KE means cost of equity in this case is 16%. Now, let us see the example of constant growth. If the dividend per share of the company is expected to be rupees 15 per share next year, and it is expected to grow at 10% constantly. That means the growth is constant. It is growing at the rate of 10% year after year. Now, we need to calculate cost of capital for equity if the market price of share is rupees 50. Okay. We will simply place the values in the formula where KE is equal to 15 divided by 50 market price of share plus growth rate, that is 10%. Now, 10% is written as 0.10 here. The value we will get is 40 or 0.40, which is 40%. Okay. So, cost of equity in case of constant growth here is 40%. We will also see one example of CAPM or capital asset pricing method as well. Now, a company wishes to calculate its cost of equity using CAPM approach. The risk free rate of the return is 10%. Firm's beta is 1.5 and the return on market portfolio is equal to 12.5%. We need to calculate cost of equity in this case. We will simply place the values in the equation that we just discussed. So, our KE will be equal to 10%, then 10% is risk free rate plus 1.5, which is our beta factor, multiplied by 12.5, which is our market rate, minus risk free rate, that is 10%. By solving this equation, the value that we will get is 13.75%. So, cost of equity in case of capital asset pricing method is 13.75% in this case. Now, after discussing cost of debt, cost of preference shares, cost of equity, we will now discuss the cost of retained earnings. So, are retained earnings free? Obviously, the answer is no. Since we are paying no interest, no dividend, no profit, still these are not free, because why it is so? Because there is no implicit cost of capital for retained earning is there. There is no implicit cost in this case, but the capital which is reinvested in the company is not free of cost. So, how we can judge or how we can calculate the cost of retained earning? So, the cost of retained earning are considered to be equal to cost of equity. Okay. So, we are not separately calculating cost of retained earning, but the cost of retained earning are equal to, so our KR is equal to KE, that is cost of equity. Okay. So, this is how we calculate cost of capital for individual sources of finance. Now, we need to club all these cost of capital to reach to average cost of capital for the firm. We also call it weighted average cost of capital for the firm. This weighted average cost of capital is represented by WACC. You will also see there are people who call it WACC. What is the WACC of the firm? Okay. There are certain steps that we need to calculate WACC for the firm or WACC for the firm. That is, first of all, we will calculate the cost of specific source of fund. Now, there are these sources from where we have gathered the fund. These funds are in certain proportion in the company, in the capital structure. We will multiply these specific cost of funds with the rate, with the proportion or with the weight at which these are there in the capital structure. Okay. And after solving or after adding these values, we will get the overall cost of capital or weighted average cost of capital. So, the equation, or we can also call it the formula for calculating WACC, is visible on the screen, wherein overall cost of capital, which is represented by KO or WACC, is equal to, we have discussed 4 different sources of funds here, and I am using these 4 sources of funds for calculating WACC here, where weight of debt WD multiplied by cost of debt plus weight of preference share multiplied by cost of preference share plus weight of equity multiplied by cost of equity plus weight of retained earnings multiplied by cost of retained earning. So, this is the case when we are raising the fund from all the 4 sources. There may be cases, and it is generally said or discussed or seen that a company is majorly raising funds from two sources. One is debt, another is equity. Okay. So, in case the company has raised funds from these two sources only, our overall cost of capital or our KO will be represented this way, the equation which is on the lower side of the screen, where our KO is equal to KD, that is cost of debt, multiplied by D upon D plus E, that is the ratio in which the debt is there in the capital structure, plus cost of equity, it is multiplied by the ratio in which or percentage in which the equity is there in the capital structure, E divided by D plus E. D plus E represents the wholesome capital structure. Okay. Let us see this with the help of example. Now, the capital structure of the company is presented in the table. This company has equity shares, 10 lakh equity shares of rupees 1 each. So, the amount of equity share is 10 lakh. They have 15% preference shares of rupees 100 each. That means the preference share, the cost of preference share here is 6 lakh. They have 13% debentures for rupees 8 lakh. So, overall cost capital structure of the company has 24 lakh with them, right. And the proportion, how will we calculate the proportion? The proportion of equity share is equal to 10 upon 24. Proportion of preference share will be equal to 6 upon 24. Proportion of debenture will be 8 upon 24, right. We will use this proportion when we will solve this question. Now, the market price of company's share is rupees 120 and is expected dividend of rupees 12, which will be declared after 1 year. That means, this is the value of D1. The dividend growth rate is 8%, our G. The tax rate is 50%. Now, with this information, we need to calculate weighted average cost of capital. So, we can quickly jump to the formula, that weights multiplied by individual capital or specific cost of capital. But before that, we need to have the specific cost of capital as well. Okay. In case of equity share, we do not have specific cost of capital. Okay. So, we need to calculate this. Okay. How we will calculate? We will placing the value in our formulas. Its specific cost, where we have discussed the cost of equity, where we have discussed the cost of debt. Okay. We will use these formulas to calculate individual cost of capital. So, from the equations which are visible on the screen, you can see that KE is equal to D1 upon PO plus G. This was our formula. Now, we are placing the value in the formula, and the value is 12 upon 120 plus 0.08, the growth rate. So, KE in this case is 18%. KD, the tax impact will be there. So, KD multiplied by 1 minus T, that means 13% multiplied by 1 minus 0.5, which is equal to 6.5%. Okay. For preference share, it is given that the preference share are issued at the rate of 15%. Okay. Now, we will use these percentages to calculate the specific cost of capital to calculate our weighted average cost of capital. Okay. So, weights, how we have calculated the weights? 10 divided by 24, that means 0.42 is for equity shares. 6 or 6 lakh divided by 24 lakh, we will get the weight of preference shares in this capital structure, that is 0.25, and then 8 lakh divided by 24 lakh, this will give us the share of debentures, that is 33% in this case. The specific cost of capital that we have already calculated, 18% for equity, 15% which was given for preference shares, 6.5% for debentures. Now, we will multiply these values to get the values in the last column. That means 0.42 multiplied by 18, we will get the value 7.56%. 0.25 multiplied by 15%, we get the value 3.75%. 0.33 multiplied by 6.5%, the value is 2.15%. Now, by adding these individual values 7.56 plus 3.75 plus 2.15, we will get this overall value, that is 13.46%. And this is our WACC, this is our WACC, this is our KO, this is our overall cost of capital for this firm. The firm which is having 3 different sources from where they have raised the funds. So, this is how we calculate cost of capital, overall cost of capital. Now, there is another thing, we call it book value or market value. Now, the weights that we have considered, for now the weights were given, we have considered the same weights for our calculation. Now, there is a clash between book value weights or market value weights. Which of these should we consider while calculating WACC? Now, manager prefer the book value weights for calculating WACC. Why? Because the firms in practice set their target capital structure in terms of book values, okay, whatever mentioned in the books of accounts. The book value information can be easily derived from the published sources. This is another reason. The book value debt equity ratios are analyzed by investors to evaluate the risk of the firms in practice. Okay, so, this is also one of the reason why manager prefer book value weights. But the use of book value weights can be seriously questioned at times. Now, why is it so? Because the component cost which are available at opportunity rates and are determined in capital markets. So, the capital market actually represents the situation. So, the weight should also be market determined. Then the book value weights are based on arbitrary accounting policies that are used to calculate retained earnings and the value of assets. Therefore, they do not reflect the economic value. So, this was another reason why market weights should be considered and book value weights should be avoided. Then market value weights are considered theoretically superior to book value weights because they reflect economic value and are not influenced by accounting policies at all. They are also consistent with the market determined component cost. But there is a difficulty in using market value weights. The market price of the security fluctuate widely and frequently. Okay, so, it is difficult to capture weight at the right moment at the right time. At times it is not possible to capture the right price, okay, right weight. A market value based target capital structure means that the amount of debt and equity are continuously adjusted as the value of firm changes. So, every time the value of firm is changing, we have to keep on adjusting the ratio of debt and equity in our capital structure. So, that is why it is difficult to consider market value weights in this case at times as well. Now, let us see, these were the reasons why book values are not considered or why book values are considered and market values are generally considered to be superior, but because of limitations we are not considering market values. But with the help of example we will see that what is the difference between the value of WACC when we are calculating it using book value weights versus market value weights. Okay, let us try and see this with the help of example. Now, let us find out WACC through book value and market value weights using the information which is visible on the screen. Now, again this company has 3 different sources from where they have raised the fund. From debt they have raised 10 lakh, from preference shares they have raised 2 lakh, from equity shares they have raised 13 lakh. So, overall amount they have which is recorded in the books is 25 lakh. Okay. Specific cost of capital is also given. For debt it is 7%. We need not calculate this individually in this case, we are just seeing that how book value weights and market value weights impacts WACC. So, 7% is the cost of debt, 15% is cost of preference share, 16% is cost of equity shares. In the last column the market value of the same sources of funds is given. So, in this case the market value of debt is 11 lakh which was 10 lakh in books. The market value of preference shares are 2.5 lakhs which is 2 lakhs in books. The market value of equity share is 30 lakh which is 13 lakhs in our books. So, the books reflect that the capital structure of this company is 25 lakh the amount of capital structure, and the amount of capital according to the market value for the same company is 43.5 lakh. Now, let us quickly put these values in our for our WACC calculation. For book value, we will multiply 10 lakh with 7%, we get the amount of interest that we need to pay. For preference share, 2 lakh multiplied by 15%, this is 30,000 that we need to pay in the form of preference dividend. 13 lakh multiplied by 16%, the value we will get is 2 lakh 8,000 that we are paying in the form of equity dividend. So, the overall amount or overall cost that we need to pay for raising funds from these three sources will be 3 lakh 8,000. Now, this 3 lakh 8,000 will be quickly divided by 25 lakh and we multiplied it with 100 to convert it into percentage. We can see that overall cost of capital according to the book value is 12.32%. So, this value is according to the values which are recorded in the books. But when we are using the same thing for market value, okay, we will use market value, that is 11 lakh multiplied by 7% for debt. So, the amount of interest that we need to pay is 77,000. Preference capital, for preference capital we have 2 lakh 50,000 divided by 15%, that is 37,500. For equity shares we have 30 lakh multiplied by 16%, that is 4 lakh 80,000. So, the overall cost of capital here is 5 lakh 94,500. Now, we will divide this value with the market value of these sources of funds we have. So, 5 lakh 94,500 divided by 43 lakh 50,000, okay, and we will multiply the value with rupees with 100, we will get 13.6%. So, we can see from this that cost of overall capital here according to market value weights are 13.6%, whereas according to book value it was 12.32%. So, we may follow the principle of we can play safe, okay, and conservatism principle here we can follow, and we may consider the market value weight because it is showing higher cost of capital, okay. So, this is how the difference in the book value and the market value weights are calculated or can be seen when we are calculating WACC or overall cost of capital. So, this was about the cost of capital concept. So, as we come to the end of today's session on the cost of capital, let us summarize the key points we have covered today. First, we have discussed what the cost of capital is. Essentially, it is the return a company needs to earn on its investment to maintain its market value and attract funds. It is a critical concept because it serves as a benchmark for evaluating the profitability of potential projects. Then we explored the components of cost of capital, that means we have discussed cost of debt, we have discussed cost of preference shares, cost of equity shares and cost of retained earnings. We combine the cost of individual sources of finance weighted by their respective proportions in the company's capital structure to get WACC, weighted average cost of capital. This gives us a single composite rate of return expected by investors. This is known as WACC or overall cost of capital. We also touched on the importance of cost of capital in financial decision making. We have seen the impact and importance of considering book value weights and market value weights. Now, to wrap up, understanding the cost of capital is vital for both strategic and operational decisions within a company. It ensures that investments are made wisely and the capital is allocated efficiently, ultimately driving the company's growth and shareholders' value. So, as you move forward, remember to continuously refine your understanding for these concepts and stay up to date on changes in market conditions that can impact cost of capital. Practical applications and critical analysis are key to mastering this topic. Thank you for your attention today. See you in the next session very soon. Happy learning.